assignment. Okay, so Chapter 3. Okay, we've been talking about the equation, right? Assets equals liabilities plus owner's equity. And that includes revenue minus expenses, minus withdrawals. Okay. So far, I think everybody's got the equation down in their minds. Now, we're going to start talking about our classifications of accounts. We've talked somewhat about them. I've been calling them assets, and you've been calling them assets since day one, because we talked about your assets. So, asset accounts, that's one classification. Okay, one classification, assets. Assets, that's going to be the property, anything of value that the company has. Liabilities, what's that? That's what they owe, usually as a result of purchasing equipment or an asset, right? Okay. Liabilities. That shows the debts that must be paid in the future. Then our owner's equity. What does that indicate? What does the owner's equity account show us? How much he's got left, right? His net worth. It shows you that the liabilities include what somebody else still owns of your property, right? Those creditors. They still have a claim on it. Anything that shows up in owner's equity is free from any other claim. That means the owner has full claim over it. It's his. Paid all the debts on it, right? And it's his. All right. Shows his financial interest in the business. Okay, we're going to look at the book's going to present it as a T account. And all it's going to do is the T is going to show you that in every single account, no matter what it is, we have a bunch of asset accounts, and maybe several liabilities, maybe one owner's equity. And we need to keep up with, in one place, what is happening in each one of our accounts. So, what we did in Chapter 2 was we had it written across a spreadsheet showing each account, and then it just added up pluses or minuses of what happened underneath that account so that you could have a balance at the bottom, right? That's really not a very good way to keep up with it. We need to have a place where we can keep up with each particular account, and as things happen, we're going to write in there if that account was increased or if it was decreased, or, right, and as things happen, we're going to keep up with the balance in that account so that at any time we could go look up, let's say, cash and say, oh, I've got this much in cash. All right, so T accounts and the effects of the transactions. We've talked about this already. We went through this completely, right? In Chapter 2, we talked about what happened, right? What accounts were affected. Remember, we talked about cash going down and equipment going up if we bought equipment. So what accounts? We look at each transaction and we determine, well, okay, what happened in this transaction and what accounts were affected? And you might say, well, okay, cash, the owner put some money in the business, so cash was affected and his owner's equity was affected, right? So what kind of an account is cash? It's an asset because it has value. What kind of account is the owner's equity? Huh? Remember our classifications? What were they? Assets, liabilities, owner's equity, revenue, and expenses. Those are your 5 kinds of accounts. So the capital account falls under the owner's equity accounts, right? Or his equity. So that's a kind of account. Capital. All right, so we figure out what kind of account it is. That's our next step. We're looking at the transaction. Okay, cash, an asset, and his equity, an owner's equity account, or his capital account, the owner's equity account. It all means the same thing. Capital, equity, net worth, that all means the same thing. So, then what? Then we have to determine, well, okay, did cash go up? Did cash go down? Did owner's equity go up? Was it increased? Or was it decreased? So that's the next part of our analysis. Then we're going to talk here in a minute about the left side and right side of each account and apply those rules. So there's a rule for each kind of account. Assets has a rule. You're going to just have to memorize these. Assets, liabilities, owner's equity, revenue, and expenses. You must memorize which side is increased and which side is decreased for each type of account. And I think there's a little chart in your book that you can use to memorize those. Just part of it. You're just going to, at this point, till it becomes logically natural, we're just going to memorize that chart. All right. Then we're going to make the entry in T account form, which means, okay, I sent over some handouts. Did they bring y'all some sheets?
Yeah, we got them.
Okay, I'm going to do, if you can make copies of these or run them off, I'll send them to you in an email, so if you want to go in and make you a bunch of copies, because we're going to use the T account on each one on a separate sheet of paper. Carolyn withdrew $100,000 from her account, put it in the business. Our analysis is what was affected. We've done this one before, right? So what kind of accounts were affected? What was affected first? Owner's equity and cash were the two accounts that were affected, right? We got cash. Cash went up. And also her owner's equity was increased, right? So, if we're looking at each account, each account on that T has a left side of the T and a right side of the T. Everybody see that? A left side, a right side. On every transaction, you must have the same amount as a left side entry as you have the right side entry. Guess what that does to the equation? It keeps us in balance.
Are we supposed to be writing something?
It's in your book. You can just be looking in your book if you want to. Okay. Page 55. We're just talking about this. So here's the T. We have cash and we have capital. Cash is an asset account. Asset accounts are increased on the left side of the T account. Owner's equity accounts are increased on the right side of the T account. So that when we make our entry, we have a left side and a right side of equal value, keeps our accounting equation in balance. Okay. If it was laid out on that spreadsheet, you'd see it on both sides. When you would see a plus on this side, plus on that side, would stay in balance. All right. Let's look at another one that we've already done. We purchased some equipment for $5,000. Let's analyze it. What happened? What kind of accounts were affected?
Cash.
Cash was affected, you're right. And what else? And equipment. Because we wrote a check. It's real easy. Usually, I would always look first to analyze what happened to cash. if it's involved. That's the easiest one to determine, did it go up or did it go down? So once you get it determined, then you know the other part of the transaction's got to be an equal amount on the other side, right? So if cash went down, which it did, and it's an asset account, so it is reduced on the right side, then what went up? Equipment. Another asset account, and asset accounts are increased on the left. Okay. What if we buy some equipment only we don't pay cash? We promise to pay it later, which is usually within 30 days, and it's usually, yeah. So, we won't talk about debit credit here in a minute. Yeah, so the firm bought equipment for $6,000, and he bought it. When it says on account, that means they didn't pay cash. So what accounts are affected? Okay, equipment, and what kind of account is equipment? It's an asset. All right? Now, when we buy things on account like this that are short term, or maybe long term, but what happens is the accounts payable, since we didn't pay cash, becomes a what? A liability, right? We got to pay for it. So a liability account is affected, and an asset account is affected. Did the asset go up or down? Up. Everybody agree? We've got equipment. It's in our door, sitting over there in the corner. It's worth something, right? So the asset went up. What else happened? The liability went up because it's an accounts payable. And remember, if you were looking at our spreadsheet, it would be one side, both went up, stayed in balance. So equipment, asset, left sides increased. Liabilities increased on the right side. All right. Is everybody getting a glimmer? You see, you're just going to have to memorize the little chart to figure out how the accounts are increased on which side. So if we issued a check to purchase office supplies, what happened here? What kind of accounts were affected? That's right, 2 asset accounts. Supplies is an asset, it went up. Cash is an asset, it went down. So we have a left and a right entry for equal amounts. One asset went up, one went down. We stay in balance. As long as you have your left side entries equal to your right side entries on your double entry, when you're doing transactions, you will stay in balance.